Good evening, and welcome to the Crypto Overnighter. I'm Nicodemus, and I will be your host as we take a look at the latest cryptocurrency news and analysis. So sit back, relax, and let's get started. And remember, none of this is financial advice. And it's 10 p.m. on Monday, July 10th, 2023. Welcome back to the Crypto Overnighter, where we have no sponsors, no hidden agendas, and no BS. But we do have the news, so let's get to that. Tonight, we'll start by exploring the mysterious depths where Bitcoin whales are making waves, buying up Bitcoin despite its recent flat trading. Then we'll surface to the legal storm brewing for the Terra Co-Founder Daniel Shin, who's facing charges related to that failed crypto project. We'll also journey to the horizon, where central bank digital currencies are rising, with predictions of a digital currency revolution by the end of the decade. We will then navigate through the choppy waters of the EU's MiCA legislation and its impact on private stablecoins, a regulation that's causing ripples of controversy in the crypto world. We'll also take a look at Coinbase's stock performance, which is soaring high despite an ongoing lawsuit from the SEC. And finally, we'll end our voyage with a cautionary tale about the rise of crypto scammers on the new microblogging app Threads. So buckle up, don't forget to like, follow, and subscribe, and let's dive in. Despite Bitcoin's recent flat trading between 3,000 and 31,000, the Bitcoin sharks and whales have been busy. Since June 17th, they've bought approximately $2.14 billion worth of Bitcoin. That's around 13.20 million Bitcoin, which is over $391 billion at current prices. This buying spree happened over the past 3 weeks, with these investors snapping up 71,000 Bitcoin. There have been some recent developments that have sparked optimism in the industry. The world's largest asset manager, BlackRock, filed to launch a spot Bitcoin ETF in the United States. This is a big deal because BlackRock has a stellar record, with 575 out of its 576 products being approved by the SEC over the years. Other finance giants like Invesco, WisdomTree, and Fidelity Digital Assets have followed suit. This flurry of activity from major institutions could lead to mass adoption of Bitcoin. Now let's shift gears here a bit and look at the long-term holders of Bitcoin, those who've been in the ecosystem for at least the past 155 days. They currently own almost 14.5 million Bitcoin, with a significant amount purchased between April and early July of this year. Bitcoin performed well during this period, closing its second consecutive quarter in the green for the first time since the bull market in 2021. Those long-term holders have shown increasing appetite for Bitcoin, even during the crypto's not-so-good days. For instance, when the once prominent exchange FTX collapsed at the end of 2022, causing massive losses for its clients and undermining the legitimacy of the industry, these investors continued to buy. Institutional investors, including investment firms, hedge funds, private funds, and others, have also shifted their focus to Bitcoin. You know, I'm not one given to slinging around a bunch of hopium. That said, monitoring their holdings provides valuable insights into market dynamics and investor sentiment. It also highlights the confidence that these institutional investors have in Bitcoin as a long-term asset. So despite the ups and downs, it seems the big players in the game are betting on Bitcoin's future. Now, speaking of big players, let's switch gears to another major player in the crypto world who's currently swimming in hot water. And hey, if you're enjoying our deep dive into the crypto ocean, don't forget to like, follow, and subscribe to our podcast. We promise to keep you afloat with the latest news. Usually, when I'm talking about a Terra-Luna co-founder, I mean Do Kwon. But not today. Daniel Shin is also a co-founder at Terraform Labs, and he is also in hot water. The South Korean Seoul Southern District Court has begun preliminary hearings for Shin and 7 other former Terra employees. Shin is facing a slew of charges related to the failed Terra-Luna cryptocurrency project, including fraud. However, he did not attend the hearing, choosing to remain silent. The Terra-Luna project was a significant endeavor in the crypto world, with Shin and Do Kwon playing key roles in developing the Terra USD and Luna cryptocurrencies. But their involvement took a dark turn, leading to a market collapse that wiped out $40 billion in value. Now, Terra USD was designed to be a stablecoin, but that didn't stop it from taking a nosedive in May of 2022, falling as low as 10 cents apiece and breaking its one-to-one peg with the US dollar. Prosecutors believe Shin knew the price peg system was algorithmically unachievable. Yet they allege that he deceived global investors by artificially maintaining the coin's prices through manipulative trading practices and fraudulent publicity campaigns. The Luna Classic market cap is currently at $524 million, which is a long way from the $40 billion it was once worth. Shin has assembled a robust legal team of over 30 lawyers to fight the charges. Despite attempts by law enforcement to secure an arrest warrant against Shin, the courts ruled in his favor, stating that he posed no flight risk and was actively cooperating with investigators. However, concerns remain that Shin might attempt to dispose of his assets, leading the prosecutors to seize over $100 million of Shin's funds. The first trial in the court case against Shin is now in full swing, with the first hearing held on July 10th. Shin was accused of several infractions, including violation of the Electronic Financial Transaction Act, the Act on Aggravated Punishment of Specific Economic Crimes, and the Capital Markets Act. He was also accused of conducting illegal sales of Luna tokens, which he had not declared possession of. That sale reportedly brought in about $106 million, funds that Korean authorities have since confiscated. Shin denies any involvement with the collapse of Terraform Labs. He said he ended his engagement with the company in 2020. His legal team requested more time to prepare for the trial, citing technological considerations that could not be neglected. The judge agreed to extend the discovery period of the case, with the next hearing set for August 28th. And we have to talk a little bit about Do Kwon. He was recently incarcerated in Montenegro for having false identity documentation. After his short 4-month sentence is up, Do Kwon will be likely extradited to either South Korea or the United States to face charges. From legal battles to the future of digital currencies, let's move on to our next story. But before we do, remember to hit that like button and subscribe to our podcast for more crypto news. Now, let's talk about the rise of CBDCs. According to a survey by the Bank for International Settlements, 93% of central banks are researching CBDCs. By the end of this decade, we could see around 15 retail CBDCs and 9 wholesale CBDCs in circulation. This includes major jurisdictions like India, the UK, and the European Union, who are seriously considering issuing digital versions of their fiat currencies. The work on retail CBDCs is more advanced compared to their wholesale counterparts, with 1 out of 4 central banks revealing that they are piloting a retail CBDC. However, not all institutions are on the same page. For instance, Hong Kong Central Bank is focusing on a wholesale CBDC first, taking 2 to 3 years to build the wholesale layer before considering retail. Currently, there are 4 live retail CBDCs in the world, issued by the Bahamas, the Eastern Caribbean, Jamaica, and Nigeria. The number is expected to rise by the end of the decade. The UAE has launched its CDB strategy called the Digital Dirham, and other regions are making steady progress on this front. Now, let's look at the implications of these developments. The BIS survey suggests that if crypto assets, including stablecoins, are widely used for payments, they could pose a threat to financial stability. This has led to a push for stronger and coordinated regulatory approaches to contain their risks to the financial system. Interestingly, 60% of central banks surveyed said that the emergence and proliferation of stablecoins and other crypto assets have accelerated their work on CBDCs. Interesting but not surprising. Stablecoins and cryptocurrencies point out the flaws of the traditional financial system, and so they want CBDCs to appear to address those same flaws without giving up the control needed to actually address those flaws. However, not all central banks are convinced of the necessity of a state-backed digital currency. While some have become more likely to issue a CBDC within the next 3 years, others have indicated that they are less likely to do so. In the United States, the Treasury Department has not yet determined if it will pursue a CBDC. Meanwhile, the state of Florida has banned CBDCs, deriding the innovation as Big Brother's digital dollar. As we move forward, it's clear that the world of CBDCs is evolving rapidly, with each country charting its own course. While CBDCs are gaining traction, private stablecoins are facing some regulatory hurdles. And speaking of hurdles, if you're enjoying our podcast, don't forget to like, follow, and subscribe. Now, let's dive into the impact of the MiCA legislation on private stablecoins. The European Union's Markets in Crypto Assets legislation was signed into law on May 31st. Some of the repercussions are only now making themselves known. MiCA stirred up some controversy in the crypto world. The law really is the world's first regulatory guidance on cryptocurrencies. It includes a daily transaction cap of 200 million euros for private stablecoins like Tether and Circle's USDC. This cap has been met with criticism, with some saying that it could stifle the use of large stablecoins. Stablecoins aim to mirror the price of fiat currencies, and they are an important part of the ecosystem. They were introduced to address the price volatility of cryptocurrencies like Bitcoin and Ether. However, the collapse of Terra's algorithmic stablecoin, Terra-USD, in May of 2022, as well as the brief depegging of USDC following the collapse of Silicon Valley Bank in early 2023, have led to increased regulatory focus on private stablecoins. The cap is not a ban, and if the threshold is passed, issuers will be required to cease further issuing activities and to work with regulators to bring transactions under the cap. But with the increasing popularity of private stablecoins, some fear the use of certain larger stablecoins will quickly become stifled. Meanwhile, the Association for Financial Markets in Europe, AFME, raised concerns about the exclusion of decentralized finance from the MiCA regulation. The association believes that an all-inclusive regulatory framework covering both traditional financial services and DeFi is necessary. The AFME warns the current regulatory approach, which bypasses the DeFi sector, could trigger potential risks, including threats to financial stability and secondary implications. The organization argues that despite the current overlap between DeFi and traditional finance being relatively limited, it requires active surveillance and management. The AFME also sees DeFi as a significant innovation in the financial system and believes that the EU should develop a taxonomy that categorizes DeFi activities and digital assets. They recommend adopting a risk-based approach to DeFi regulation to ensure consistency across varying levels of centralization. So while the MiCA legislation is a step toward regulating the crypto market, it has been met with criticism and calls for revision. The exclusion of DeFi from the regulation has also raised concerns, with calls for a more inclusive regulatory framework. From regulatory challenges to legal battles, our next story takes us to Coinbase's ongoing tussle with the SEC. And if you're enjoying our podcast, don't forget to hit that like button and subscribe for more crypto updates. Now, let's see how Coinbase's stock is faring in the midst of all of this. So, Coinbase has been making the headlines lately. Despite facing a lawsuit from the U.S. Securities Exchange Commission for allegedly offering unregistered securities, Coinbase's stock has been on a steady climb. Since the lawsuit was filed, the company's stock value has increased by more than 50%. On June 6th, the stock was around $52, and by July 7th, it had surged to $78.7. This represents a 6-month growth of about 133% and a year-to-year growth of roughly 50%. While the stock has been growing, some of Coinbase's top executives, including the CEO Brian Armstrong, have been selling their shares. On July 6th, a total of 88,058 shares worth about $6.9 million were sold by senior executives. However, some major investors like Cathie Wood's investment firm ARK Invest have held on to their shares, with Wood expressing confidence that Coinbase's share price would soon rise as Bitcoin's price increases. The SEC's lawsuit against Coinbase began on June 6, 2023. The SEC claimed that Coinbase had been offering investors unregistered securities since 2019. In a recent letter, the SEC argued that Coinbase, a multi-billion-dollar entity with sophisticated legal counsel, intentionally disregarded established legal precedent, including the landmark Howey test, to create their own criteria for what constitutes an investment contract. The SEC's letter also highlighted Coinbase's own acknowledgement of the risk that assets traded on its platform could be classified as securities. The regulator quoted from Coinbase's public statements, emphasizing that the company had consistently informed shareholders about the potential violation of federal securities laws. The SEC presented evidence that Coinbase was well aware of these laws and had even communicated the potential violations and associated risks to its shareholders. Coinbase, in response, has appealed to the court to dismiss the case on the grounds of lack of jurisdiction and claims that the SEC did not follow due process. The outcome of this case will have significant implications for the regulation of cryptocurrencies and their trading within the United States. As the legal battle continues, the crypto community eagerly awaits a resolution that could shape the future of the industry. As we navigate the highs and lows of the crypto market, it's important to stay vigilant against potential threats. Speaking of threats, our next story is a cautionary tale about crypto scammers on Threads. And remember, if you're finding our podcast helpful, Don't forget to like, follow, and subscribe. As if we need one more place to be on the lookout for scammers. Recently, there's been a surge in signups for Meta's new microblogging app, Threads. Since its launch on July 5th, the platform has seen its user base climb to over 98 million. But all is not well in the world of Threads. Some users from crypto Twitter have raised alarms about potential scammers on the platform. These scammers are impersonating high-profile crypto Twitter users on Threads. Wombex Finance, a decentralized finance platform, has already spotted a Threads account pretending to be them. They've warned their followers that this could be a scam, as they're not actually on the platform. The NFT influencer Leonidas also raised a red flag. They've alerted their 93,000 followers about scammers on Threads impersonating them and other large NFT accounts. To fight these impersonators, Leonidas created an account on Threads. Jeffrey Huang, also known as MacG Big Brother on Twitter, has also been targeted. A user pointed out to him that there was a Threads account impersonating his Twitter persona. So far, these impersonator accounts have not shared any scam or phishing links. They've mostly been posting crypto-related content. Twitter has long been a hotbed for crypto phishing scammers. They often hack into the Twitter accounts of well-known people and businesses, posting malicious links. These links aim to trick unsuspecting users into sharing their crypto exchange login, a crypto wallet seed phrase, or connecting a wallet to a crypto-draining smart contract. In just the first half of this year, the phishing scams like these have stolen $108 million worth of crypto. So while the new Threads platform is growing rapidly, it also seems it's attracting the attention of scammers. This is a reminder to all of us in the community. Stay vigilant and cover your assets. So what happened? Tonight we started with the Bitcoin whales who are swimming against the current, buying up Bitcoin despite its recent flat trading, showing their confidence in its future. We then moved on to the legal troubles of Terra Co-Founder Daniel Shin, who's facing charges related to the failed Terra-Luna cryptocurrency project. We also discussed the rise of Central Bank Digital Currencies, with a prediction of 15 retail CBDCs in circulation by the end of the decade. We examined the impact of the EU's MiCA legislation on private stablecoins, a regulation that has stirred controversy and calls for revision in the crypto world. We then looked at Coinbase's stock performance, which has been soaring despite an ongoing lawsuit from the SEC. And finally, we ended with a cautionary tale about the rise of crypto scammers on the new microblogging app, Threads. And that's going to do it for us tonight. I want to thank you, my listeners, because when you stop listening, I will stop talking. If you enjoyed tonight's show, then please like, follow, subscribe, leave a rating, or maybe a review. And in the meantime, we'll see you tomorrow night.